Hello and welcome everybody. How you doing here today? I was out of the office today, but I wanted to make sure to get this done for you guys. So I got a lot of good stuff. So I wanted to go through it, show my commitment. We're back at this. We're doing it. And all is good. Hey, let's dive in here and take a look at the market. Yeah, that looks good. Here's the S&P here starting to pull back. What did we talk about? We talked about the pullback in the market there. I don't know that this is going to translate into a more meaningful pullback. I think what you see is a little excitement out of the Fed meeting. We'll cover some of that in a second, and maybe some jostling as we go through the rest of the end of August. That would actually be totally normal there. So I welcome, a nice pullback, but I have no belief that there's going to be just some crazy decline from here. I think you'll see some back and forth. Let's take a look. What I did last night is I put the 2-year, what we call rolling returns, right? And all that means is just we take a 2-year window and use it, and then we take another 2-year window and another 2 years, right? So we're not cherry picking the different years that we could do. Well, if you take all the 2-year rolling returns since the very, very start of the S&P being a thing, right? September 1928, you find that here's the median rolling 2-year return, right? It's about 18%, 17, 18%. Well, orange, right? Here's where we're at. We're way above even the top most best performing areas. So when we go into the things that we've talked about over the last couple of days, where we say, there's going to be a pullback, or we're hoping for a pullback. September tends to be weak. We've rallied into September. We have lower volume going into September. We have interest rate concerns, inflation concerns, tariff concerns, blah, blah, blah. We're going to cover all that. Well, we're way ahead of schedule. What did we talk about yesterday? Being ahead of schedule is not a bad thing, but it means that we may need to make some adjustments, right? And I've seen the comments and everything from you guys. I love the comments from that. And by the way, actually, one of the comments, just so I'm going to jump around a little bit. One of the comments was, we showed this the other day. We said, well, here, take a look. We have, I'm sorry, I'm in the way. But we have September performance being weak. If you've been watching for the last couple of days or for any amount of time, you know that I shared this with you. Well, somebody said, that's the Dow. United Healthcare on Friday could skew the performance in the Dow. It's 30 stocks, right? Let's look at the S&P. So I said, well, all right, I have no life. Let's do this at night. So I put this together last night. Here is, now it's going to be a little bit different because we're currently in September, October, November. You see what's happening. So I said, well, let's do the S&P. Well, in the S&P, if we look at the September seasonal returns up here at the top, you're going to see it is still the weakest. So the Dow, the S&P, Nasdaq, right? They're all in the same camp. But as you look through, you go, okay, that's why it's the weakest, right? Look at how September tends to be what we would call seasonally weak. You can screenshot this, take it for whatever you want, but that's where we're at. So we have an overperforming market. We talked the other day about how the market is way above average for its average quarterly return. And I keep these slides, so you guys know. Okay, that's a joke. I didn't keep that slide. Right? Stay. Hold on. Don't go. I didn't keep it. Okay, so we know that the average quarterly performance is way ahead of schedule. We know that September tends to be weak. We know that the market's overbought. We know that 36% of all stocks in the S&P are considered overbought. And when we get into that 36 to 40% range, the market likes to take a break. Look at NVIDIA. Look at the stocks that are starting to take a break. It's not rocket science. It's just a matter of watching things as they go. Now, I'm actually going to jump here real quick. I want to share this real quick with you. And we're going to go to the Jackson Hole discussion. I want to share this with you just to further clarify that what we're seeing is consistently being seen. Because my opinion, don't listen to me, right? You could watch anybody, but I like to look at stats. So this is all going to be stats. Let's look at the Russell 1000, the 1,000 biggest stocks in the market, right? And compare yesterday's performance to the year-to-date performance. I'm going to slow this down a little bit because I think this is kind of really important. If we put the 1,000 stocks into 10 buckets based on their year-to-date performance, in other words, this bucket would have the worst year-to-date performance. It would be 100 of those stocks. Then this bucket would be the second 100 stocks that had the worst year-to-date performance, and so on until we get to the best year-to-date performance. Well, take a look. If we look at yesterday, we've been mentioning this and we've been going at this from all different factors. The best performers year-to-date were the worst performers again for yesterday. This has been going on for a week now. The second best performers year-to-date have been the worst. What does that mean? It means that those that have performed well have seen profit taking. People have said, I will sell some. I'm not selling all. I'm not scared. I'm going to sell some. And where am I going to put that money? I'm going to go put that money towards the worst performers. Look, they had the best performance. The stocks that have had the worst year-to-date performance out of the top 1,000 stocks by market cap have done the best, right? So in other words, it's a continuing rotation, right? But your boy Dustin doesn't want to just give you that. Like that's cute. That's an easy thing. You could track it yourself. What if we go a step further? When when investors in the market get defensive, worried, maybe they're concerned about the growth continuing, where do we go? We go to utilities. We go to consumer staples, right? What do those stocks have in common? They have a higher dividend. So if we look at yesterday's performance relative to the dividend that it pays, the stocks with the highest dividend, let me make sure you can see. Yeah, okay. The stocks with the highest dividends did the best yesterday relative to the stocks that have the lowest dividend. In other words, the growth stocks. So people are rotating, and this is just another way to look at it. They're rotating out of the growth, low dividend, high volatility stocks, and they're going towards a little bit safer, right? There's concern. And maybe they're wrong. I'm not saying they're right, but at the moment, the money is moving over there. And we've been talking about this for almost a week now. If we look a little bit further, this ranks the performance yesterday by price to earnings, right? And price to sales. So we're going earnings and we're going revenue, right? Like what's happening here? Well, the stocks that have the lowest price relative to the earnings that they bring in, they've done the best. And it's kind of really interesting because it's across the board. But when you go to the stocks that have the highest price relative to the earnings that they bring in as a company, those are getting sold off. NVIDIA is a good example of that. You can look at that today, right? Wow. What a shift where we see that money going a little more defensive and a little less growth. What does that mean for you? Does it mean that the market is overbought, going to fall, going to crash? This is the end? No, it means that everybody knows the same thing that I've been sharing with you. September is weak. We have a strong move into September, and maybe I'd like to take some skin off the table. It's the same thing, right? Notice the repetition. I don't come in here and just try to share my personal beliefs, whatever. I like to share the data. If we look one step further, lowest market cap to highest market cap. Okay. If we take those 1,000 stocks, we put them into little buckets, where's the money going? Into those stocks with lower market cap, in other words, at the bottom of the Russell 1000, I'm sorry, and moving away from those that have the highest value or company value, right? We say market cap, but in other words, Apple's worth $2 trillion, whatever, right? That's a high market cap versus Home Depot. You get what I'm saying? So we see this shift going on here and you go, okay, am I going to play along or am I going to ignore it? What are you going to do? We know what we're doing. So at Jazz, we manage our own funds here. And so we have the ability to make changes as we wish. And we always kind of make this joke. We're not afraid to say it. The more your account grows with us here at Jazz, the more money we make. I'm not afraid to say it because it's not like I'm charging you 100% of the growth, right? You can look on our website. You pay 0.5%. I want your account to be as big as possible. So if I notice this shift where September's weak, we're rallying into it, valuations are a little bit higher. We got Jackson Hole coming up. We got inflation concerns. We got the Fed coming up, right? If I notice that I can make those adjustments, and I shared the performance yesterday actually with our funds, if I can make a change that means you pull back less and rally more, I make more money. Eric makes more money. Chris, Haley, Matt, we all make more money. I'm actually not afraid to say that because it means you made a lot more money, right? For somebody that's actively participating in what you're trying to do versus just, hey, I'm going to buy a mutual fund and I'm going to go play golf or, disc golf or whatever that stuff is. And I'll just, talk to you whenever. I don't like that. We've never liked that here. So a little bit different thing with Jazz Wealth. Hope you check us out at jazzwealth.com. All right. We got to get on to Jackson Hole. It's a thing. It's happening. It's a beautiful place. I can't afford to go there myself, but I hope you get to visit there one day. Let's take a look. So the 2-year, if you don't know, the 2-year Treasury yield is a proxy for the Fed funds rate. That's what we follow on a day-to-day platform basis because we don't know what the Fed's going to do. So the the yield of the 2-year fluctuates based on the beliefs of what the Federal Reserve is going to do. So if you ever want to see, that's kind of how you look at it. Well, we know that's proxy. So on the screen, what we have is put together the data, the change in light blue so far this year of the 2-year leading up to today, the start of the Jackson Hole meeting. Now, the Jackson Hole meeting doesn't always last these 3 days, so it's a little bit you're getting the accurate data here. And then we said, okay, over the last 20 years, while this has been a thing, let's look at the 2-year yield leading up to, see the 0 mark there, and then after what tends to happen. Well, if we look through that, the 2-year, or I'm not going to say it this way, but what we would perceive to be the Fed funds rate, I'm going to say 2-year, falls into the Jackson Hole meeting. And that's exactly what's happening now. The 2-year yield has actually fallen into the start of this meeting. It's good news if you like lower rates. After the Federal Reserve, after the Jackson Hole meeting, rates tend to increase, but not by as much as they fell, which is really good news if you're in the middle of looking to buy a house or spend some kind of credit that you were hoping for lower rates on. We'll see if that happens again. Now, in 2023, you got it. 2023 was the biggest move that we saw in the last 20 years from the 2-year yield inside of the Jackson Hole meeting. And the reason was the comments that Jerome Powell made at the time was, we're going to be focused on more restrictive policy for some time, meaning he was not going to cut rates. He was looking to be tight with the money, right? And so we saw a big return there. They said, we're prepared to move interest rates at any time if appropriate. Those are his words, not mine. That was the biggest move we saw. And so think about what's happening in this meeting. We have Jerome Powell doing, it's going to be his last Jackson Hole meeting. I mean, it's just the way it's going to go. So we had, in 2023, we had this last rate hike before that Jackson Hole meeting. It was in July, actually. And so now we're coming into a moment where the Fed knows, the Fed doesn't like to surprise the market, period, right? You notice how they're very clear about, we're considering this. We realize employment or unemployment is at this rate. We're up to the potential of a rate cut. We'll take a look at the markets. We believe that we should be doing this or that. They're very, very cool about, we don't want to surprise the market. Okay, well, then we have this Federal Reserve meeting coming up at Jackson Hole, and the belief is 85% that they're going to cut rates in September. So at Friday's Jackson Hole meeting, when Jerome Powell speaks, if he wants to endorse the fact that they're going to cut, there's 2 other guys that need to chip in here, otherwise it's not going to happen. But if he wants to endorse a Fed rate cut, he'll do it at the Jackson Hole meeting. It'll be clear as day. He's not going to actually say we're going to cut rates, blah, blah, blah. But there will be clear intentions that is the path they're going to follow. That's why this is so important. That's why the markets are like, What do we do? Do I watch? Do I not watch? What was he going to say? If there's no belief based on the data that he's got coming in, which I'm of the camp that we don't need to cut rates. I don't understand why you would cut rates. This is not my job. I'm not an expert, but in my humble belief, just leave it, right? Keep money a little bit tighter. Everybody's got money. It's fine. But if there's no intention of cutting rates, expect nothing. He's not going to come out and say, well, we just, based on the data, don't know. We shouldn't cut rates, whatever. No, he'll totally avoid it. Watch this. This is like, you want to like come back later and watch this video and go, wow, how'd you know that? Watch how he'll say nothing about cutting rates. He'll just talk about policy, the economy. We're a little concerned here, a little concerned there, whatever, but there'll be no mention of rate cuts. That's how you know whether it's going to happen or not. This is a repetitive cycle. This is something that happens. There's not really, there's no science behind it. This is just how it goes. Okay. Lastly, from our friends at Goldman Sachs here, tariffs, right? Do you know where tariffs stand? Did you notice how it was like a really big deal for about a month? And now you have no idea what tariffs are being placed on which countries and where. It's just like, oh, we have a deal. I don't know if we have a deal. We're going to extend this by 30 days and we're going to wait and we're going to talk and we're going to meet. Did you notice that? What happened? It fell out of the media hype, but these things are still actually happening. So our friends at Goldman Sachs helped us out with this. I put in a request to see where in the heck are these tariffs and expected tariffs. So if you're curious, China still sitting just over 45%, Vietnam, and basically everybody all the way to the EU sitting around 20%. We have every country here listed, almost every country listed. This is where tariffs currently stand. And it's important to point out because I don't really care like if you're like pro or against it, or I love Trump, I hate Trump. It doesn't matter to me. It's what we have, right? I have to work with what we have. So what's important here is at this current rate of tariffs, we can support the deficit, which, honestly, the big beautiful bill it causes quite a bit of a deficit. It's 8 to 10 billion a year. It's not pretty. This current level of tariffs supports that, provided that there's no inflation, right? And that's a big one, right? Someone's going to comment on this and go, oh my God, yeah, how do you get around inflation? I think that's a problem. I'm with you on that one. But at this current rate of tariffs, as you see on the screen, we support the big beautiful bill for everything that it has, whether you agree or disagree. Okay, well, so there's a balance there, right? This guy right here, this is going to change. I don't know where things land on that one. I was just curious to kind of start the conversation about tariffs and not let it just float to the bottom of the headlines, because it's really important. These are hundreds of billions of dollars we're talking about that will either flow through or pull through companies like Home Depot, Best Buy, right? Like think about these names, Estee Lauder with their makeup. You think that stuff's made here in the States? How do you think that goes? Anyways, let me make sure I covered everything. Hey, tomorrow we're going to be covering the latest on covered call strategies. So we got a bunch of data here. We're going to talk about the performance relative to the S&P, how you can beat the market with selling covered calls. We're going to go over a handful of stocks and exactly how to do it. So we'll go over all that data up to the second. And yeah, that's all I got. I couldn't make it to the office today, so I wanted to make sure that I at least got this out. The bottom line is, where do you think this market's going to go? I think that this turns into people going, oh my God, we fell 1.5%. I'd like to buy. I don't know where it goes from there, but we're walking into a weak month. You got to be careful here. You can't be 100% all in at this point. I don't think. I'm not allowed to tell you what to do. But We will see. As you look around, oil finally getting a little bit of a bounce there. Bonds, minor bounce, but that's going to be a little bit volatile with the Jackson Hole meeting going on. Gold, small bounce, but it's not really doing much of anything. And the VIX, got to point out the VIX again with a nice little rally there. People are expecting for September to be a little bit volatile. And if you're not expecting it, shame on you, because we've been hanging out for the last couple of days here talking about September performance. And now you have the Dow, you have the S&P, you have where we're at. There's not much more I can do, right? Anyways, I hope I helped you. If I did, please consider subscribing to the channel. It really helps us out a lot. If you're looking for a financial advisor other than the big guys that don't pay attention to you, Jazz Wealth. We work with Goldman Sachs. It's your money. We don't touch it. We're 100% fiduciary. We cannot do anything wrong there for you, but we love doing things right. So I hope you'll check us out there. jazzwealth.com. Schedule a call, email, whatever you like to do, or just get started right on the website. Adios.